This is part 1 in our short-term business decisions series, and here we'll be discussing costs and incremental analysis. So the first thing we need to do is distinguish between relevant and irrelevant costs. Relevant costs are costs that are incurred in the future, and those costs will differ among your alternatives. So whether you're deciding upon choice A or choice B, those costs will be different if they're relevant. Irrelevant costs are costs that will not change in the future, and they do not differ among your alternatives. So choice A and choice B, a particular cost is not going to change no matter which decision you make. That cost would be considered irrelevant. Then we want to look at an incremental analysis. An incremental analysis is how income would change under each alternative. And to do this, we're going to take a look at a new form of an income statement called the contribution margin or contribution income statement. In this income statement, it will separate your costs by behavior. Now, what do we mean by behavior? Well, costs can behave in different ways. Costs can change, or costs can stay the same. That's your behavior. So a contribution margin or a contribution income statement starts with sales. From sales, we're going to subtract our variable costs. So remember our discussion on variable cost. Variable cost in total will change depending on our activity level. So we're going to subtract our variable cost. That will give us what we call a contribution margin. From contribution margin, we're going to subtract fixed costs. Remember, fixed cost did not change in total depending on activity level. And that will give us our operating income.